Hello, welcome back to episode 5 of What's Up Insurance. This week we're going to talk about the health savings account, also known as the HSA. I alluded to this in last week's video a lot when we were talking about the high deductible health plan, and that's because they go hand in hand. Oftentimes they are used interchangeably, but they are not the same thing. So I want to spend a moment just to define what the difference is. So the high deductible health plan we talked about last week, or HDHP for short, is the medical plan component. Okay, so that is the plan that encompasses your deductibles, your co-insurance, and that kind of thing. The health savings account, or HSA for short, is the bank account that goes along with that high deductible health plan. And we'll talk about how they work together today. But just wanted to clarify, they are not the same, although they're often used interchangeably. They're not the same thing. Okay, so let's go ahead and get started. We're going to talk about what an HSA account is, how it can benefit you, how you can use it, some of the rules the IRS puts in place, some of the future benefits of it. So without further ado, let's get started. Okay, so this week we're talking about the health savings account. Health savings account is a tax-favored savings account. It is tax-favored in 3 ways. The first way is that the money you put in the savings account is pre-tax. When it comes out of your paycheck, it's a pre-tax benefit. So that money goes into your bank account or your savings account before your taxes hit your check. So it, to a certain degree, lowers your kind of your tax bracket, not really the bracket, but really the amount of money that's coming out of, the amount of money that's coming out of your check is kind of lower because the amount of taxes that's coming out of your check is lower because you're putting money away pre-tax into this health savings account. So that's the first tax benefit. The second is that the money you spend out of that account, as long as it's spent on health-related expenses, that money is also tax-free. And then the last thing is that the money you accumulate. So you're saving money in a savings account. That money is also tax-free. So it's tax-favored in 3 ways, okay? Money you put in is tax pre-tax. The money you spend is tax-free, and the money you save and accumulate is tax-free. Okay, you own this account. If you open an HSA account and you're on a high deductible health plan or an HSA compatible plan, you own the HSA account. You take it with you if you leave the company. If you if you cease to be on a high deductible health plan, you still have this money in the account. Even though you can't actively contribute if you're not on a high deductible health plan, you still have the money available to you in your account. You own the account. You fund the account. You put the money into the bank account pre-tax out of your paycheck. You elect with HR how much you want to go in there, and then they pull it out of your check pre-tax. Now, your employer can also contribute funds in there, but once the funds are in there, it's yours. So even if the employer contributes funds and you leave the company, whatever they've contributed up to that point belongs to you in your account. Again, I said this earlier in the video, but the money can only be used for health-related expenses, okay? But that's not limited to medical. It could be dental expenses. It could be vision expenses. When I'm doing these presentations with my clients, I sometimes say, if you want those fancy Coach glasses, or you have some dental work that needs to be done and you don't have the money to cover the expenses, you can use the money in your health savings account to cover other health-related expenses. Now, be careful, because with prescription drugs are considered health-related expenses, but over-the-counter drugs are not considered health-related expenses unless they are prescribed. So if your doctor gives you a prescription for Tylenol, then that's considered a health-related expense. But if you just go in for Tylenol over the counter, or some vitamins or something like that, those are usually not going to be considered health-related expenses. So it's important to make sure you use the money on health-related expenses. If you don't, there are some penalties that you can incur. You can incur tax, meaning it's no longer pre-tax if you're using it on non-health related expenses. And you can also incur a penalty. So the government can charge additional money if you are using this account for non-health related expenses. So it's very important to make sure that you guys are using the money on your health related expenses. Okay. Now, this account is regulated by the IRS. So, of course, they have some rules, right? The first rule is that the IRS has a minimum deductible, okay? Follow me for a moment. A minimum deductible and a minimum out-of-pocket maximum that has to be on that high deductible health plan in order for it to be HSA compatible. So that means you cannot be covered by an HMO plan or even your standard PPO plan. You have to be covered by an HSA compatible high deductible health plan. And the government sets those minimums every year. They change sometimes. The government can say whatever they want it to be, that minimum deductible, minimum out-of-pocket maximum. So you want to make sure before you look into opening a health savings account that the medical plan you're on is an HSA compatible high deductible health plan. Okay, in addition to the fact that the government has minimum deductibles and out-of-pocket maximums, they also can regulate the maximum amount of money that you can put in your account annually. Okay, so the government can say you can only put a maximum amount as an individual and a maximum amount as a family. They regulate that. That number can change. It can fluctuate within the policy year. It can fluctuate at the beginning of the calendar year. I posted a video on my Instagram last week, maybe 2 weeks ago, that talked about the 2020 limits have already come out. So the government has already released those, the increase for 2020. For 2019, the limit is $3,500 for individuals and $7,000 for families. If you are over the age of 55, you can contribute what we call a catch-up contribution up to $1,000 into that account on top of the maximum. But the government sets the annual maximum. Now, catch this. Even though the government sets a maximum on the amount of money you can put in annually, they do not set a maximum on the amount you can have in that account as a whole. So you may be limited to what you can put in on an annual basis. But if you're having a healthy year and you're not going to the hospital or to the doctor's office a lot and you're not spending money out of that account, it can continue to accumulate and roll over every year, and you can continue to save money in that account until you need to use it. So even though they regulate what you can put in, they do not regulate how much you can have in there at any given time. So that's good to know. In addition to the rules we've already talked about, you cannot be covered by Medicare. You cannot be claimed as a dependent on someone else's taxes. Okay, so those are two things to remember. Now, you can have dependents who are claimed on your taxes and use the benefits or use the funds that's in your health-related expenses to cover their health-related expenses, even if they are not on your medical plan. I'm going to say that again. So I'm going to use it as an example. So let's say, for example, you're covered by a high-deductible health plan at your job. Your spouse is covered by an HMO or PPO at his or her job, and the children are on your spouse's plan. If your spouse and children are IRS-defined dependents on your taxes, even if they are not covered by your plan, you can still use the money in your health-related or your health savings account on their health-related expenses. So their co-pays, their hospital bills, you can use the money to benefit that as well. So that is a really good feature to note, that you can use the money on that as well. Okay, and I want to reiterate that there is a penalty and there is taxes that can come out, that can come off that money if you use it on non-health related expenses. So make sure you use it on health related expenses. If you're unsure, ask HR. You can Google it. You can also ask the bank account, but you just want to be sure that you're using on health related expenses. Don't buy a TV. There's going to be a penalty and there's going to be taxes on that. So you want to make sure you're using it on your health related expenses. Okay. So there are also future benefits to having this health savings account. So I mentioned this penalty, but after you turn age 65, if you still have this health savings account and you have money in it, then you can use it on non-health related expenses without incurring that penalty. Now, you still may be subject to taxes, but you wouldn't incur the penalty after age 65. So a lot of people like to use these types of accounts to save for retirement. After you reach a certain amount in your account, a lot of the bank accounts that offer these savings accounts will allow you to invest it. So kind of like a 401k, you can invest the money into different avenues and let it grow interest and all of that kind of stuff. So another way to be able to use this account to save money and build wealth for your future, for your retirement. So contributions, you can change your contributions throughout the year. So even though most people make their elections at the beginning of their policy period or plan year during open enrollment, if, for example, you put in, let's just say $1,000 in there, and then all of a sudden you have a bad accident or you have a hospital stay or something like that, and you need more money in your account, you can change it. You can go to HR and say, hey, increase my contribution. Now, it's not going to happen immediately. It comes out over the year, right? So whatever you tell them to put in there, it's going to be broken out by your pay period. So it'll come out over the year, but you at least know that you're putting money in there to cover those expenses as they come up. I like to tell people just at the beginning, go ahead and put your out-of-pocket maximum in there at the bare minimum, because then at least you're never going to spend more than what's in your bank account because you've put your out-of-pocket maximum in there. That's what I did this year for my family. We put our out-of-pocket maximum in the health savings account. So we know that we're not going to ever go over what's in our health savings account. But if we have a healthy year and we don't max out, then that money can roll over. I did mention last week, this is one of the key benefits between this plan or this bank account and the high deductible health plan, and then the PPO and HMO. So with the PPO and HMO, you don't have access to this kind of savings account. You could use a flexible spending account. We'll talk about that next week, but they're not the same perks as a health savings account. So with those plans, if you're on a PPO or HMO, you have a really healthy year. Good, you had insurance, but you don't have this money that's in the savings account that can roll over and accumulate for you like you would on a high deductible health plan. So that's kind of what I like about it. Not saying that it's the best option. All the different plans have their different benefits, and the different bank accounts have their different benefits. Flexible spending account has some benefits as well that we'll talk about next week. But those are some of the things that I like about the health savings account. The other thing to note, and this is a question I also get a lot, people ask me, well, what happens if I get in an accident on day one and I don't have money in my account accumulated to cover my hospital bills? So here's the thing. When you're on a high deductible health plan, 9 times out of 10, probably 9.8 times out of 10, the hospital is not going to ask you for they're not going to make you pay up front when you get to the hospital. What they're going to do is bill your insurance. Insurance is going to apply their discounts, and then you're going to get an explanation of benefits from your insurance company, and you're going to get a bill from the hospital. At the point that you get that bill, most hospitals, if not all, will let you put it on a payment plan. As long as they're getting some money, they're okay. So they'll let you put it on a payment plan, and you can just give them the information for your health savings account, and you know that money is accumulating out of every pay period. It's going to be there. So go ahead and let them take the money out on a payment plan from your health savings account, and you will be okay. So don't fear if something happens right away. You know, day one, you open this health savings account and something bad happens. It's okay. There are ways to work around it. This video is intended to be high level. I've already gone over my time, and I get so excited about this stuff because there's so much knowledge and information to share. I appreciate you guys joining me. If you have specific questions, feel free to comment. If you want to share some of your experiences with people who are looking at the video, feel free to comment. If you have personal questions that you want to DM me, feel free to do that as well. I will, like always, post these videos to my archive videos to my YouTube page. So the link is in the description box. So feel free to like and subscribe to my YouTube page and check out the archive videos. You can also follow me on Instagram at @what_the_insurance. I'm on Instagram. I do post my archive videos there as well to my IGTV channel. And I also post additional things to that page that you may not see on my Facebook page. So check me on Instagram. Check me on YouTube. I hope this was helpful. Comment below if you felt like this was helpful. Thank you guys for sticking with me. And join me next week. We will journey into the next subject of spending accounts, which is the flexible spending account. So have a great week. Thank you guys.